Primary security markets. Primary markets are where issuers first sell their securities to investors. Issuers generally contract with an investment bank to help them sell their securities to the public. Investment banks line up subscribers who will buy the security. This process of lining up subscribers or investors is called book building. Broadly speaking, either we could have an underwritten offering or a best efforts offering. In an underwritten offering, the investment bank guarantees the amount of securities to be issued and the price. For example, the investment bank might guarantee that 1 million shares will be sold at $20 each. If it turns out that the offering is undersubscribed, in the sense that out of the million, only 800,000 shares have been purchased by investors, then the investment bank will buy the remaining 200,000 at this price. The other strategy is a best efforts offering, where the investment bank says to the issuer that it will make every effort that this many shares will be sold at $20 per share, but it's not a legally binding commitment. An IPO, or initial public offering, is one sort of a primary market transaction where the issuers sell securities to the public for the first time. And as discussed here, this transaction is facilitated by the investment banker. The investment bank and the issuer typically agree on the issue price. Let's say that they agree on a price of 20. If this price is too low, then chances are that the IPO will be oversubscribed, which means that the interest in the IPO is more than the number of shares that are being sold. Undersubscribed IPO, which I referred to a moment ago, is where the price is perceived to be relatively high by the public, so the number of shares that they would be interested in would be fewer than those shares that are being offered. Also note that there is a conflict of interest in the relationship between the investment bank and the issuer. The investment bank is an agent of the issuer, and as an agent, the investment bank should try to raise as much money as possible for the issuer. However, in its capacity as an underwriter, the investment bank would have an interest to have the price as low as possible, especially if the investment bank is buying some of these shares. It would like to have those shares at a relatively low price. A secondary or seasoned offering is also a primary market transaction. Here the issuer sells additional units of a previously issued security. You might have an issuer that in 2010 does an IPO, and then in 2013 there might be a secondary offering where the same issuer issues new shares, and those shares are then sold with the help of the underwriter to the public. Private placement. Sometimes companies sell securities directly to a small group of qualified or sophisticated investors as opposed to the public at large. This would be called a private placement. Since these investors are sophisticated, which means that they understand the risks, their financial knowledge is more than the public, therefore there are relatively low disclosure requirements. A private placement generally would be less costly compared to a public offering, be it an IPO or a secondary offering. This last bullet is important, and it connects primary markets with secondary markets. Everything that we've talked about here is related to primary markets. This is where companies actually raise money. Secondary markets, which we will discuss on the next slide, is where investors who have bought the shares from the company then trade with each other. Strictly speaking, in the secondary market, when investors are buying and selling, the company does not get any of this money, or the issuer does not get any of this money. However, if a given security has an active secondary market, it makes it much easier for the issuer to raise money in the primary market. Also, if the stock is doing well in the secondary market, that means that the company could then have a seasoned or secondary offering at a high price. The price in the secondary market determines the price at which the issuer can then have a secondary offering. Let's talk about secondary security markets in some detail now. Trading in securities takes place in a variety of structures. We will consider three aspects of the market structure: trading sessions, where we can either have call markets or continuous markets, execution mechanisms, and market information systems. Let's talk about trading sessions first. In the context of trading sessions, we can either have call markets or continuous markets. In call markets, trades can be arranged only when the market is called, and it would be called at a particular time and a particular place. When the market is in session, buyers and sellers find each other very easily. So we have a very liquid market. However, when the market is not in session, then it will be completely illiquid. Usually, these sessions happen once a day. With continuous trading markets, trades can be arranged and executed anytime the market is open. And the link between call markets and continuous markets is that many continuous trading markets start their trading with a call market auction. Execution mechanisms. There are three kinds of execution mechanisms we'll talk about. First, a quote-driven market. This is where customers trade at prices which are quoted by dealers. Quote-driven markets are also called over-the-counter markets, price-driven markets, or dealer markets. And in these markets, the dealers provide the liquidity. Next, order-driven markets. Here, trading is based on rules. Traders supply liquidity to each other. Since the traders are trading with each other, there need to be some rules for how orders will be matched. There are two categories of rules that we need to be concerned with. Order matching rules, which match buy orders to sell orders. These are generally based on price and time. Obviously, if somebody is trying to sell, or there are multiple people who are trying to sell, whoever is selling at the lowest price will get precedence. In terms of time, clearly somebody who comes in first will get precedence, but first priority goes to the price. We also have trade price rules. These trade pricing rules determine the actual price at which the transaction will take place. This material is covered in more detail at level 3. Right now you need to understand the high level points which are illustrated well in example 27, and we look at an example very similar to this one on the next slide. Before we do that, let's just understand the third execution mechanism, which is a brokered market. Here, brokers arrange trades among their clients. These are used for instruments where finding buyers and sellers is not easy. You need a specialized broker who can go find a counterparty. If it is easy to find buyers and sellers, then typically you would have a order-driven market. Let's look at an example now where we are talking about filling a large order in a continuous trading market. At the start of the day, we have a limit order book for stock X, which looks like this. And then Tom submits an order to buy 150 shares, and the limit price is 34. How will this limit order book change? I want you to use common sense and come up with a revised limit order book before looking at the solution. So here is what happens after the order. This is clearly a marketable order. Tom wants to buy 150 shares, limit is 34. First, he will go to Sam and clean this up. This is the most aggressive seller. He is selling at 33. So Tom will buy 40 at 33. Then he will buy 60 units or 60 shares at 34. Tom will not buy from Sue because Tom's order is a limit order with a limit at 34. So Sue's order still remains on the limit order book, which means that out of 150, Tom has only filled 100. 50 still remains. In other words, Tom is now one of the buyers who is willing to buy 50 at 34. So his order now is on the limit order book. The next part is to determine Tom's average purchase price. He purchased 40% of his shares at 33 and 60% at 34. So we take a weighted average and come up with 33.6. We will now talk about the characteristics of a well-functioning financial system. Number one is the existence of well-developed markets that trade instruments that help people solve their financial problems. We would call this complete markets. If in a given market there are no derivative instruments, then it might be difficult to manage risk, and we would say that that market is not complete. Second, liquid markets with low cost of trading. In other words, markets which are operationally efficient. With low cost of trading, it is relatively easy for companies to issue bonds. It's relatively easy or low cost for companies to issue equity, which makes the market operationally efficient. In secondary markets, if the operating costs or the trading costs are low, then that provides a liquid secondary market which supports the primary market, as we've discussed earlier. Number three is timely and accurate financial disclosures. Timely and accurate financial disclosures support informationally efficient markets. Investors are much more comfortable when they have accurate, reliable financial data, because with this sort of data, they can make investment decisions. So timely and accurate financial information does not in of itself guarantee informational efficiency, but it definitely supports efficient markets. And finally, efficient markets themselves, where if in a market prices reflect fundamental values, then markets are said to be informationally efficient. Markets where investors and issuers agree that prices are fair and reflect fundamentals would be markets where investors are more willing to invest or more comfortable investing. Market regulation. Market regulation has several objectives, and we'll cover them briefly over here. Clearly, an important aspect of market regulation is to prevent fraud. Next, to control agency problems. We have talked about agency problems in corporate finance, where if a company is owned by shareholders and managed by the management team, then there are potential conflicts of interest between the managers and the shareholders. Rules and regulations need to be in place such that companies are managed in the best interest of shareholders. Market regulation needs to promote fairness, set mutually beneficial standards. To illustrate this point, when companies are required to follow accounting standards such as IFRS, that benefits both companies which issue financial reports as well as the users of financial reports such as investors. Prevent undercapitalized firms from exploiting their investors by making excessively risky investments. This is self-evident. Market regulators also try to ensure that companies take the necessary steps to meet long-term liabilities and obligations. That brings us to the end of this long reading. Let's summarize the main points. You are supposed to understand the main functions of the financial markets. The financial markets allow people to save money, borrow money, raise capital, manage risks, to exchange assets with each other, and to trade on information. The financial markets need to facilitate all of these items. Financial markets should also allow us to determine relevant rates of interest across different types of instruments. And finally, financial markets should be such that capital is allocated to the best possible use. Next, we need to understand various intermediaries and the roles that they perform. For example, you need to understand what dealers do, what exchanges do, brokers, securitizers, insurance agents, and so on. We then talked about different kinds of positions. A long position is where you own a given security or contract, and that's fairly straightforward, so we don't spend too much time on it. But a short position is more testable in the context of this reading. A short position is where you borrow a security and sell it. You take a short position when you expect the price of that security to go down. Levered positions are positions where you borrow money to buy an asset. With levered positions, you need to recognize the concept of initial margin. Initial margin of 40% means that 40% of the asset price must be paid by you, and that is at least 40%. You might have a maintenance margin of say 25%. This means that if the stock price comes down or the asset price comes down, your equity needs to be at least 25%. There is also the concept of a call price, where the broker who has given you the margin loan will call you. That price is given by the following formula. It's the initial price that you paid into 1 minus the initial margin divided by 1 minus the maintenance margin. Obviously, the initial margin and maintenance margin are in decimals. For these numbers, it would be 1 minus 0.4 divided by 1 minus 0.25 and multiplied by the initial stock price. You also should be able to do some basic return calculations for situations where you have a leveraged position. And the simple trick for doing a return calculation is to recognize the initial cost, and then at the end, when you liquidate or close out your position, you need to figure out how much money you are left with after you pay off your debt and pay off your transaction costs. And then between the cost and the final amount of money, you can calculate the return. Next, we come to order instructions. We can have execution instructions, validity instructions, and trading instructions. The testable ones are execution and validity instructions. The most important execution instructions are market orders or limit orders. A market order is basically saying that the order should be executed at market price. The benefit of a market order is that it executes fast. The potential negative of a market order is that it might execute at a price that you don't like. If you are trying to sell and stock prices are going down, then you might end up selling at a very low price. With limit orders, you specify a price. So a sell order with a limit of 30 means that the order will execute at 30 or more if it does execute. The type of validity orders include day orders, where a day order is basically saying that an order is valid for the day, and if the order is not filled during the day, then it is cancelled. Another type is good till cancelled, which says that the order is in effect until it is actively cancelled. We also talked about stop buy and stop sell orders. Primary and secondary markets. Primary markets are markets where the issuer is selling shares, and generally the process is facilitated by investment banks. Secondary markets are markets where investors trade with each other. A liquid secondary market greatly supports primary markets. When the secondary markets are liquid, then it makes it easier for companies to raise money in the primary markets. You need to recognize the distinction between quote-driven markets, order-driven markets, and brokered markets. Quote-driven markets are also called dealer markets. These are markets where a dealer is sitting in the middle making the market, and the dealer sets his bid-ask prices. Traders then come in and trade with the dealers. Order-driven markets do not involve dealers explicitly. Here, traders trade directly with each other based on certain rules. Brokered markets are markets where a broker is identifying the buyer and seller. Generally, brokered markets are for instruments that are not very easy to sell, or instruments where it is hard to find buyers and sellers. You need to understand the characteristics of a well-functioning financial system. Markets should be complete, which means that the entities in the market can perform various sorts of functions, such as buy and sell securities easily, issue different kinds of securities, manage risk, and so on. Markets should be operationally efficient, which means transaction costs should be low and liquidity should be high. There should be a sufficient amount of accurate information, which facilitates informational efficiency. And finally, we talked about the objectives of regulation. Objectives include minimizing or preventing fraud, promoting fair and orderly markets, and trying to ensure that markets are as safe and efficient as possible. Now I want you to go over the summary. This is a very long reading and the summary is quite good. Review the learning objectives. I have referenced several examples. Make sure you do the examples that I mentioned. If you have time, then you can also go over the other examples. Definitely do the practice problems. They are very good. And also try to do practice questions from other sources.